Hey everyone, today we're talking about becoming investment savvy. Investments 202 today. My name is Isaiah Goodman, Chief Financial Advocate at Becoming Financial. We've already talked about Investments 101, some of the basics of stocks, bonds, and mutual funds. Today I want to go a little bit deeper and talk about some of the other investment instruments that you may or may not have heard of. One of the first ones, and typically the safest, is called a CD, a certificate of deposit. You take that to a bank, you give your money and say, hey, I want a $500 CD. They'll give you some sort of a time frame and say you can come and get this money back within 60 months. So that's 5 years. And they'll guarantee an interest rate like 3%. So in 5 years, you come back, they will have compounded 3% interest every year. You get your money back. It's basically guaranteeing to the bank, I won't take this money out. You can go use it for your loan purposes. And then when I come and get the money, I want that interest on top of it. It's a really good, safe, sound investment. It's federally insured. You don't have to really worry about it. Now, the downside is you're not getting great interest rates. You might get maybe 1 or 2%. As interest rates rise here in the next few years, you'll see those start to grow. But it's not typically keeping up with inflation. At least it hasn't in the past decade. Another good instrument is called a money market account. Same sort of thing where money's typically quote unquote safe. Obviously, the value of your money market account can ebb and flow a little bit, but it's essentially a slush fund where dollars are deposited and it just sits in there in cash. So when you think about investments in stocks, bonds, and mutual funds, there might be some other investments in a money market account where your money is just sitting in cash, but behind the scenes, they're trading and investing, trying to make a couple extra percentage points at the end of the year off of your cash. Another good one, corporate bonds. So I talked a little bit last time about bonds with the government and a teeny bit about corporate bonds, but there's a couple different ranges of corporate bonds. One of the first ones is secured corporate bond. So you give your money to the bond company. They're going to say, hey, this bond is secured. It's guaranteed by the company and their cash flow. Another one is convertible. What that means is you can get the bond and you can actually convert it into equity or stocks of the company. So if you think a company is kind of up and coming on the rise, maybe you buy some bonds to provide them some cash, and then you put a note in there, or obviously the note is in there that says, I can convert this to shares of the company. So if maybe the shares are $10 per stock right now, and they rise to 100, you convert it, you now have made that big profit. It's a really cool way to save and invest some money and give you a little bit of flexibility. The last one are just income bonds. So you can have bonds that pay out a little bit higher of a guaranteed income every year, but they're going to be a little bit more risky. So maybe it's a company that's growing, but there's some more risk into it. You're going to be getting higher interest rate from those bonds because it's, number one, a corporate bond, and number two, there's a more default risk going into it. Now I'm going to talk a little bit about federal bonds. There's a few of these. Number one is called a T-bill. Essentially, when you're looking at a government bond, a T-bill is going to be the shortest time frame, typically somewhere 30 to 60, 90 days. Short-term bonds that are going to give you some sort of quick return. Obviously, the government is using the money for whatever sort of purposes they have, but they're going to give you money back in a shorter time frame. And then you have a T-note. T-notes are typically when you get into the number of months. So you want your money back, you want to have a good investment, it's guaranteed by the government, but you're going to have a longer sort of duration in the months or even a couple of years. And then a T-bond, a treasury bond, is long-term. So you're looking at several years, 5, 10, 15, 20 years. Obviously, you're going to get a longer payback of your money. It's going to take longer to get all of your money and interest, but typically those have the highest interest rates. Because if the government's going to borrow your money for 10 years, they're going to have to pay, a good return for that, or at least acceptable in terms of market. Another couple cool ones that have grown in the past few years. There's some bonds that are out there from the government that will basically manage or keep up with inflation. So they're treasury protected. What they're going to do is they'll monitor the consumer inflation rate. So if inflation went up 2%, your bond's going to pay 2%. If inflation didn't go up at all, you just get to keep the note. There might be a minimum threshold percentage, And if inflation went up 5%, they might have a couple years to catch up. Maybe they're going to pay 2% for the next 3 or 4 years. But essentially, your bonds are guaranteed to keep up with inflation. So that's something a lot of investors have liked to use over the past few years. Now, as we move on to other bonds, I'll quickly touch on things like state bonds. You can have municipal, so like a city bond, they need to build a park. You can have a government one at the state level. Maybe they need to do some sort of big project on the freeways or something like that. And you can also have bonds that are specific for a certain project, like a big new stadium or something that has a finite sort of, hey, we need to raise $2 billion. We're going to give this sort of return. And then once the project's done, it's over. So again, there's different levels. You can have corporate, you can have federal government, and you can also have your state or local city as well for many different types of bonds. So we've talked a little bit about some of the safer things. Let's talk a little bit more about some of the more aggressive investments. Now, there's different types of investments out there. We talked a little bit about equities and mutual funds. There's more that are becoming popular, like exchange-traded funds, ETFs. Essentially, what these do is they're going to be index funds that are monitoring a set of certain types of stocks or equities, but they're tradable. So you can say, hey, I want to trade these types of funds, similar to a mutual fund, but they're traded on the exchange. So you buy a stock like a mutual fund, it's traded between consumers, between investors. It's not going back to the mutual fund at the end of the day. So if you buy American Funds Mutual Fund or Vanguard, any of the big ones, they're the ones who hold it. You're buying a piece of that company, right? But an exchange traded fund, you're trading that with other individual investors, even though that mini fund is invested in a ton of other different things. Basically, it's who owns it at the end of the day. Other couple ideas, UITs, Unit Investment Trusts. Those are some basically complicated partnerships where they're going to have investments put inside of a trust designated towards a certain purpose. It starts to get pretty complicated. If you're getting into that space, we'll talk more about that in the future. Another one is a REIT, a Real Estate Investment Trust. Its sole purpose is to buy and hold and sell real estate investments. Minimum percentages have to go towards the dividends, towards the shareholders every year, and only a certain amount can remain in the fund. But it's a really good way to get involved into real estate without actually owning a building or an apartment or something like that yourself. You're actually able to invest in a REIT, get the dividends based off of all the hard work that they've done in real estate, and then you get the proceeds. So those are just a few more examples of the different types of stocks, bonds, mutual funds, etc. Just going to the next level of investments. Join us next time when we talk about Investments 303. We'll get into more of the things like derivatives, like stock options and puts and calls, all the exciting things in the world of investing.